Alright, while everybody on here is dissecting this week's headlines and what Pow Pow might do or say on Wednesday, some are expecting a perfect Fed and perfect economic numbers, and others are waiting for negative sentiment. This is what I've been seeing all day on YouTube. So, we're gonna forget about the drama and the GDP debates, and we're just gonna focus on 3 setups that are screaming buy at me right now, plus 1 hedge to protect us if everything goes to hell. Plus, I noticed nobody's really talking about how gold got annihilated last week and flushed down 9% from all-time highs, while Bitcoin broke 114,000. Some believe that the gold is like the boomer safe haven asset and Bitcoin is the millennial growth asset. But when one collapses and the other explodes, that's a weird divergence and does not feel random at all. It's big money positioning in those assets and rotating out of the other one. Also, treasury yields dropped, which makes stocks more attractive, on a relative basis at least. Think of it like this: if you can get 4.5% risk-free in bonds, why risk capital in stocks? But if bonds drop to under 4%, suddenly that equity risk premium looks a lot better. Just some context also, when inflation cools, the Fed has room to cut. And when the Fed cuts, equities rally. That's common anyways. But 2025 trading has been uncommon. But we still have a 96% probability of a 25 basis point cut on Wednesday, and that's already priced in. But Pow Pow's press conference at 2:30 p.m. on Wednesday, that's the wild card. One hawkish sentence about pausing future cuts or evaluations, and this rally is definitely gonna die. So let's get into it. This is what I will do with my account. I don't like predicting. I just gonna position myself for both outcomes. That's the beauty of options. Because honestly, no one knows if Powell is dovish or hawkish. I don't know if GDP beats or misses. I don't care what CNBC says the market should do or not do. What I do know, we're ripping. We're at all-time highs with the VIX around 16. And we're heading into 3 massive data releases. That's a recipe for making money. Volatility. So I've got bullish setups ready if this continues, and I've got hedges ready if it reverses. When you're trading with a small account, like I do, you can't afford to be wrong and stubborn. You take the trade, you define your risk, and if you're wrong, you cut and run. Let's get into this. My first setup is Tesla. Current price is at $452. The 52-week high is $488. On October 22nd, so a couple days ago, Tesla crushed earnings, revenue beat, margin beat, delivery guidance raised, but stock flushes in after hours almost 7%, even more. October 27th, 4 days later, Cantor Fitzgerald upgrades Tesla to overweight with a $510 price target. So we got earnings momentum plus fresh institutional upgrade. That's a 1-2 punch that brings in new and old buyers. EV sector rotation is live and well. Money's flowing back into electric vehicles after months of sideways chop. Tesla, as always, leads the move. I've got support at $430. That's the previous pivot. It's been tested 3 times in 2 weeks and held every time. I got resistance at $488. That's the 52-week high. That's also a psychological barrier. Break it and there's no overhead supply. We're in blue sky territory. I got RSI is 60 bound. That's neutral to slightly overbought, honestly, but not exhausted. We've got room to run before hitting overbought at 75. MACD got a bullish crossover with a positive histogram. Volume profile shows heavy accumulation between the $420 and $450 zones. As long as we stay above those prices, bulls are in control. We got over 36,000 open interest call contracts on the 870 and 880 strike expiring March of next year. That's 6 months out almost and way out of the money, totaling a premium of $15 million. So somebody's buying that. And those are not lottery tickets. If institutions are buying 870 and 880 calls, they're expecting a multi-month rally. That's a forward-looking signal in my opinion. We got volume put call ratio at 0.51. That's bullish. More calls than puts, which means sentiment is skewed long. My entry is at $460.50 because that's above the current consolidation at $460. You gotta wait for confirmation that the breakout is real before you risk any capital. Don't jump the gun. Wait for the level. My stop loss is at $446.50. That gives us a buffer for noise. Risk is $14 per share. Sizing is very important. So let's say you got $5,000 account and you're a robot when it comes to stop losses and capital preservation. You should be only risking 2% per trade. That's $100 of risk. $100 divided by $14 per share equals buying 7 shares. Or just buy one call option at the money with a rigid $100 max loss. But in all honesty, if your account is small, you shouldn't be in this rate. But this is what I do with my small accounts almost every other day. But I am super strict about capital preservation. The second setup I'm trading is a lot better for small accounts. Anyway, so let's see. Take profits. Target is $470. That's halfway to resistance. I'll sell 50% of my contracts. Then if we hit 480, I'll sell 25% of my contracts. Then if we break the 52-week high, I'll let the final 25% run with a 3% trailing stop. I'll just hold this for 2 to 7 days max. This is a swing trade, not a long-term hold. You are trying to catch momentum, taking profit and moving on. The setup will be invalidated if we open or break under $446. We don't touch it. We just leave it alone. Just get out immediately. No hoping, no praying, no comeback. You cut it and run. Preserve capital for the next setup. Alright, my second setup is NVIDIA. Ticker NVDA. I honestly do not like trading NVIDIA that much, but I made decent money doing that and it's screaming at me right now. Current price is around $191. Its 52-week high is $195.60. On October 15th, HSBC upgraded NVIDIA from a hold to a buy with a $320 price target. I know that sounds insane, dude. We're at 191. But here's the context. AI infrastructure is not slowing down. Microsoft, Meta, Google, Amazon, they're all spending billions in data centers and every single one runs on NVIDIA chips. NVDA earnings are November 19th, 3 weeks out. Institutions don't wait for earnings. They position ahead of the print based on supply chain data, customer spending, and channel checks. So that's what's happening right now. Semiconductor sector rotation is live. Money's rotating out of defensive and into growth, and semis are leading that move. Risk is on. I got support at $187.50 zone. Basically yesterday's morning gap up. The zone was tested multiple times last week and at the beginning of October. I got resistance at $195.50. That's all-time high. We're $4 away. If we break it, there's no resistance above. It's a clean breakout into uncharted territory. Yesterday was a really tight consolidation after that gap up in the morning. It stayed below the highs, typically moves upwards. or slightly positive news, although I ignore that noise. But here's the thing, the RSI is overbought at 72. That's on the 4-hour time frame. But at 61 RSI on the daily, so I've got plenty of room to run before hitting overbought on the daily at 70 or 75. I got the MACD bullish diversions forming. The histogram is positive, which means momentum is still there even during yesterday's consolidation. It is also above the value area high based on the 1 month, 1 hour time frame and the 5 days, 5 minute time frame, which usually means it's overextended and might come down to its value area high or even its POC. The POC is a point of control. It's basically where most buyers and sellers agree that's the right price or the fair value price for that share in a specific time period, day, week, month, whatever. I like Weeble's volume profile indicator because it outlines all of these levels, unlike other brokers where you have to find them yourself. Anyways, volume put call ratio is 0.35, which is very bullish. Not as skewed as Tesla, but still a lot more calls than puts. My entry will be either at the $190 zone for a small morning pullback or a break above 192 with a 15-minute candle close. Basically because that's above the current consolidation at 191.80 cents and it confirms we're breaking out towards the all-time highs. You want the candle close at or above 192, not just wick it and come back down before you put in any dollars. My stop loss is 188 if I enter at 192, and it's 186 if I enter at 190. You and I will be risking $4 per share. Again, position sizing is the same thing as Tesla. Let's say, again, $5,000 account, 2% risk, $100. You divide that by the 4, which we're risking per share. That gives you 25 shares. Or you can buy 2 call options at the money with a max $100 loss, so $50 loss on each contract. Because these are much cheaper, almost half off Tesla's at the money call option contracts. My profit target will be 195. I will sell half my contracts. You've hit resistance and locked in gains. There will be some price reaction up there, 100%. If we break all-time highs, my second price target is 196. That's the extension target based on consistent upwards pressure. I'll take another 25% off. Target profit number 3 trails the rest with a 3% trailing stop. If NVIDIA rips into earnings hype, you let it run. Time frame 2 to 3 days for a quick pop with a 10 DTE contract, 10 days to expiration contract. If you bought shares, you can hold on to earnings. You can hold on to through earnings if momentum sustains, or buy a 30 DTE contract at the money. Those are really expensive though for a 5,000 account, so you shouldn't be really in that anyways. But if you have very good capital preservation skills, go for it. If we break 188 and close under with a 15-minute candle, you're out. No exceptions. You have to be very strict with a small account. It's all about preservation. You gotta thrive slowly but surely. Do not go for home runs ever. Anyways, this is a momentum play. If the momentum dies, the trade is dead. I also got a third set up. I never traded this stock before, so we're gonna look at it together. It's a company called Intuitive Surgical. Tell me if you guys heard of it. Ticker ISRG. It's a healthcare stock. Its current price is around $547. It closed yesterday around $551. And I'm trading it basically because it caught my attention on October 21st. It reported earnings and it obliterated estimates, revenue beats, margin beat, guidance raised. stock rips 24% in after hours and opens at 18% gains the next day. That's a crazy move for a healthcare stock. 200 billion market cap, got demand for their Da Vinci robotic surgery systems. All hospitals are upgrading infrastructure, and Intuitive Surgical owns the market. They've got 80% market share in robotic surgery, which is crazy. Also, FDA just approved AI enhanced features for their systems. That opens up a whole new revenue stream and increases adoption rates. Analyst targets have been raised to 571. Post earning plays, by the way, you have a narrow window. Momentum lasts 3 to 7 days, then it phases. The hype dies and early buyers take profit. You either catch the wave now or you're too late. I've got support at $522. After the initial earnings spike, the stock pulled back to 522, held and bounced. That's your line in the sand. You've also got resistance around 550. That's a post earnings high and a psychological round number. Break it and you're headed toward that 571 analyst target. As you can see, we got a bullish breakout after a downwards consolidation after the earnings pop. ISRG also consolidated for 3 days. That's healthy, shaking out weak hands before the next leg up, I believe. It seems like it's got a long-term trend ahead of it. RSI is 61 on the weekly chart. That is neutral to slightly overbought, not exhausted. We still got room before hitting 70 or 80, which is where momentum plays are overbought and usually maxed out. We got a positive histogram on the MACD. Volume profile, heavy accumulation between the 546 and 552 zones. Point of control is 550. That's the resistance. The volume put call ratio is at 0.29. That is crazy bullish, but this is critical. Calls dominate in dollar value. 525,000 in call premiums versus 138,000 in put premiums. What that basically means is that institutions with size are betting on upside. The put buyers are smaller retail hedgers or profit takers. My entry is at $545 since that's a confirmed break and a value area low of its 3-day consolidation. Stop loss is at 535. That's way below your support at 550, giving us wiggle room. Risk is $10 per share. Position sizing, again, $5,000 account times 2% gives you $100. $100 divided by the risk per share, which is $10 here. We can buy 10 shares or one call option with 10 DTE. But honestly, the spread is horrible on these options. There's like a major gap, so I'll just do the shares. First price target is 555. That's 50% off the table. I'm gonna sell. TP2 is 565. I'll take another 25% off if we hit that. Third one, same thing. Trail it with a 3% stop loss. Time frame 2 to 4 days. Post earning momentum fades fast. If I see volume dropping or price stalling, I'm gonna take profit early and bounce. If we break 535 and a candle closes under, I'm out immediately. Post earnings fades are brutal. Just drop it and bounce. Alright, now after all of this bullishness, let's talk protection. I'm gonna hedge with SPY 678 puts. November 7th expiry. SPY is at 685 right now. If Pow sounds hawkish Wednesday, or GDP misses Thursday, or PCE comes in hot on Friday, the rally will reverse fast, theoretically at least. My SPY 678 is my protection. It was previous resistance, now it's support. Break it, we flush to 670, maybe 665. VIX is at 16. That's a multi-month low, which makes put premiums cheap. I'm paying maybe $3 to $3.50 per contract for out of the money protection. On a $5,000 account, that's $350 max risk for insurance on 3 long positions. If SPY drops from 678 to 665, those puts go from $3 to $20 really fast. That will definitely offset losses on your longs and make you money even. If SPY rips higher and my puts expire worthless, great. I made money on Tesla, NVIDIA, and ISRG. The $350 I spent on puts is just the cost of doing business, basically. This is not a trade that you want to be profitable, basically. You're just protecting yourself against the unknown while you position for the expected. Don't skip the hedge. They're what separates, honestly, traders who survive from traders who blow up their accounts. Now my fade list. These are things I avoid like a plague. So last week, regional banks got hammered. They announced mixed earnings, credit concerns, deposit flight fears. Zions and Western Alliance specifically triggered risk-off flows that spiked the VIX above 25 midweek last week. These banks are exposed to commercial real estate, and that sector is sick and losing value. Until I think they should revamp the whole sector and maybe use those huge spaces into something the modern market needs. Anyways, they're also dealing with higher funding costs, and depositors are still moving their cash to money market funds. Until credit stabilizes and earnings improve, I'm gonna avoid them. We got the semiconductor equipment stock, Applied Materials. Everyone's hyped on AI chips, so you'd assume Applied Materials is a buy, but honestly, I don't like it. It projected declined sales while the stock trades at 25 forward earnings, which is crazy. The narrative is bullish, but the numbers are bearish. I feel like it's a trap. I'm gonna wait for technical support or clear demand signals. Third one is ELAN, Elanco Animal Health. Retail is buying this because animal health is stable, but here's the reality. Weak sales growth, declining returns on capital, underperforming sector peers. This is dead money. You're tying up capital in a stock that's going nowhere while opportunity cost kills you. Gold miners and materials like GDX and XME are so weak. Gold dropped 9% last week from all-time highs. Miner stocks got destroyed. Defensive rotation is out. Growth rotation is back in. Gold and materials are on the wrong side of the trade as of now. Sector performance tells the real story. Technology is leading the way. 2.5% AI and semiconductor names. Energy was also up 2.1% on the OPEC supply cut rumors. Industrials gained 1.9% on earnings beat. I hate those sectors, honestly. I just gonna wait, let it hit the ground, stabilize, and then consider getting into them again. But I will take a closer look at the S&P utilities sectors, XLU. Maybe I'll make a video just because of that. I feel like this sector can blow up because of all the AI and GPU energy consumption that will be needed to run those GPU farms. And that for sure will increase utilities revenue. This is a trade in the news week. Take profits fast. Use tight stops. Don't marry positions. Watch the risk management videos for detailed tips and skills that will make your small account grow better or preserve your big capital. If this was valuable, like the video, comment what you're watching, subscribe. We're just getting started. Trade smart, protect your capital, execute your plan. See you after the Fed decision.